Welcome back to the ETF Experience podcast. My name is Isabela Sagan, and today we're diving into why even the smartest people can be their own worst enemy when it comes to investing. Your returns can have nothing to do with the ETFs or stocks you choose, but rather simply you being the problem. So if you've ever sold on a red day only to see record highs the following day, then this is the episode for you. Joining me today is Trevor Cummings from TD Asset Management. Welcome back to the podcast, Trevor. It's always a pleasure to have you on as a guest, especially given your decades of industry experience in ETFs.
Yeah, listen, thanks, I guess. This is my 21st year in ETFs. I happen to love them a lot. I think they're an excellent tool to have in the toolbox. Not the only tool, of course. But today, like you said, we're here to talk about something even bigger than, investment selection some of the time.
Yeah, so let's dive into it. So, Trevor, you have a money mindset, I have a money mindset, and our listeners have a money mindset. Whether we've defined it or not, it exists. And it's the set of beliefs that we have around money. So, question for you. What does money mindset have to do with investing?
It's kind of just as you said, right? You have one whether you've thought about it, whether you've written it down, or not, right? I think the thing is, if you have a money mindset that you've not planned or given any thought to, it could probably be random at times. It could probably cost you. I guess the old saying, if you don't know where you are, it's really difficult to get where you're going, I think is kind of the statement that applies here. And like you said, we all have one. So it's important, and I think this is a really interesting opportunity for people to think about, okay, if I haven't given this thought before, maybe it's high time to start.
Exactly. So there's actually 3 ways to improve your money mindset, and that's what we're going to be focusing on today. The first one being to fight phobia, the second one to follow the 24-hour rule, and the third one to beware of the TikTok effect. So let's start off with the first one. We've all heard of FOMO, the fear of missing out, but today we'll be focusing on phobia, the fear of being in. And this occurs when you're invested, but fearful that the markets will crash and you're going to lose all of your investments or capital. Why is emotional discipline the single hardest thing about the investment game?
I think it's a bunch of reasons, right? I mean, maybe what I would start by saying is I get it. It is one's life savings on the line after all. And so it's a really, really simple or easy path to reacting emotionally to things that are happening in the market. We've seen studies published out there that say that our reaction to pain is about twice as strong as the reaction to pleasure. So if you kind of map that to the markets, we're twice as sensitive maybe to investment losses as we are to gains. And yet the market kind of doesn't know or care whether we're invested here or there, sort of thing, right? So you can make a new investment in your portfolio, and if it goes up right after you've made the investment, unfortunately, a lot of investors, myself included sometimes, sort of validate the thesis, oh, I was right, and yet you could make a very, very wise decision in the long run, and immediately after you've made that investment decision, it can go red. Mm-hmm. And then again, emotionally, it kind of sort of feels like, I've made an error in judgment or something like that. So recency bias, or overweighting what's happened recently, I guess, as defined, is a very, very big thing as well. And maybe lastly, I'd say, look, investing isn't supposed to be fun. It's kind of boring. We'll try to make it a little exciting here, right? But it's not supposed to be something that you get emotional satisfaction out of necessarily. And so again, having that game plan going in is probably a pretty important thing to have.
Yeah, it's definitely hard to distinguish like the emotional aspect of it, like get rid of that so that it's not fun. It's just like black or white what you're doing, and you understand your process and you're sticking to it.
Yeah.
So what is an ETF solution for phobia?
Yeah, I think maybe one thing that people can think about is narrow beta ETFs or narrow index ETFs, sectors, subsectors, things like this, right? And maybe I'll unpack that a little bit. There is a difference between a good business and a good stock, and so I think about, say, some of the companies involved in weight loss drugs these days, right? That idea is very, very popular right now, or the artificial intelligence idea is very, very popular right now, but that doesn't automatically mean that all of the stocks or all of the businesses associated in that industry are going to go up, right? So the tradition maybe is you put all your eggs in one basket and you watch the basket or something like this. And with a sector ETF, you buy the basket in a way. You can buy all technology stocks, or you can buy a selection of healthcare, or you can buy the big 6 Canadian banks, for example, and not have to try to find the one that's going to do really well. The other piece to doing this really is phobia is kind of like you might buy something and it might go up, but something else in that category goes up more. That's kind of an unfortunate emotional reaction as well sometimes. So maybe it's best to buy everything in the category.
Yeah, so then you don't have to worry about, like you said, one stock going up a lot more than the one that you chose and feeling upset about that.
Yeah.
Absolutely. So this actually will bring us to our second topic, the 24-hour rule. So if you feel the urge to sell during a red market day, the rule says to wait 24 hours. And you can think about it like waiting 24 hours before buying something impulsively off of Amazon. That extra time really gives you additional hours to process the decision whether or not it's the right one for you. So how can the 24-hour rule be used when investing in ETFs or stocks?
So you can automate things, for example. Like first, let's say it's really good advice, right? Like mom's advice to sleep on it, I think usually is pretty wise. It's usually pretty sage. But that's life. You know, whether you choose to sign that lease, whether you choose to pick that university, whether you choose to accept the job offer, like waiting and considering, I think, is often a good thing. So it's major purchases for sure, but it's also large life decisions. And investing feels small sometimes, but what you do or do not do can sometimes be really impactful. So waiting 24 hours makes sense. I think also automating some of your investment approach can make some sense too. So think about setting a stop loss, for example, or a target. If this investment appreciates or goes up to that point, I'm going to automate a transaction to take profits. Or if there's a loss that's unrealized in my portfolio, instead of letting a small loss become a large loss, I can set an order to automatically take care of that. One other one maybe is just rebalancing. So, it's very human to look at your portfolio. We all want to do well. I will say the more you look at a portfolio, generally the more volatile it feels. But rebalancing is one of those things where instead of looking at a portfolio and kind of deciding, okay, is now the time to rebalance? This has gone up a lot, this has gone up a little, this has gone down. Investors might consider diarizing that or putting it in the calendar that every 6 months, I'm going to look at my portfolio and rebalance if I need to do so, as opposed to it being this, random event from time to time.
Is there an ideal time that you should wait before rebalancing?
There's a lot of schools of thought on that. I think most investment professionals tend to rebalance portfolios once a year. There's a fair amount of investors who will rebalance once a half, so twice a year, every 6 months or so. You can rebalance as often as you wished. You could rebalance every single week or something like that. But the risk is that you sort of start to spin your wheels a little bit, right? You don't want to be selling A to buy more B, only for the following week to be selling B to go back into A sort of thing, right? So often enough that you can take advantage of major market moves, but not so often that you're triggering taxes or paying extra commissions that you might otherwise not have to pay, that sort of thing.
Exactly. Those additional points to look out for as well.
Yeah.
Okay, so on to our third point, the TikTok effect. A lot of us spend time scrolling, whether that be through TikTok, Instagram Reels, Reddit, etc. And this could lead to a lot of actually algorithm anxiety, since the way that social media works is it prioritizes extreme volatility because that leads to a lot more engagement. So you're not going to see a lot of that buy and hold advice. And personally, I've never seen someone talk about an ETF that they've held calmly over the past 10 years. There's actually a fun fact, a study that was done by a survey actually by Ascent showed that 91% of Gen Z investors said that they get their investing advice from social media. That's a huge amount that relies on social media. So how can we balance social validation versus financial logic?
Yeah, I mean, I guess what I would say is, again, like one step or two steps, a few steps removed from ETFs, like we all want to be appreciated. We all want to find our tribe or our clan. And look, yours truly as well has people that I tend to follow and have regard for or affinity for and things like this. So social media can be a force for good. But as you mentioned, social media is also a tool that is manufactured to, increase or maintain engagement. And like you said, those studies are the first 10, 15 minutes or something are your interests and your hobbies or, whatever you're into. And then things sometimes take an interesting turn where the things that you consume have this tendency to elicit an emotional response. I think if you map that over to investing, that sometimes means the urge to do something. And you might have heard me say in the past, like investing is like a bar of soap. The more you touch it, the smaller it gets.
My favorite quote.
Yeah. So it's important to do things some of the time, but a lot of the time it's important to do nothing. So if you think about maybe an ETF idea for, battling or trying to resist that TikTok effect or that social media effect, you can think about, say, index ETFs. Index ETFs buy everything. So every trend that sounds urgent or sounds scarce, you got to get in because everybody else is doing well. That's automatically going to be part of an index ETF because an index ETF buys the market. So you will have those little trends. You will have those little sectors that are, on fire or actually going up and up and up. And I think the thing about a market cap weighted index ETF is those indexes, those ETFs automatically rebalance. So if a stock becomes more popular and it goes up, it automatically becomes a higher weight of that ETF portfolio. If a stock is turned to, more difficult times, then that stock, if it falls in price, it automatically becomes a lower weight to that index ETF as well.
I think a lot of people will actually be surprised because a lot of these companies maybe that are a hot topic right now, if you go to your index ETF and look at the underlying holdings, you probably hold it already without even knowing.
Yeah, you might not hold a lot of it, but it's better to hold some of it than none of it, especially if it's the future, 100x or security that's just going to go up and up and up over time.
Okay, so before we end this episode, I want to give you one challenge, Trevor, and myself and our listeners.
All right.
The 48-hour social detox. So next time the markets are red and you have the itch to check your investing app, maybe move the app to the end of your home screen or even delete it. Your ETFs are going to be doing the work for you in the background, and you don't have to worry about checking the price because it's going to go up or down whether you look at it or not. So stop checking your portfolio and start living in the moment.
Sounds like a plan. Yeah, challenge accepted.
Perfect. Thank you for joining us today. And as always, stay curious, stay informed, and stay invested.